Hello, everyone. Welcome back to Boss Economic World. I'm your host, here to peel back the layers of financial jargon, kick the tires of the global economy, and tell you the truth about your money that the suits on Wall Street and in the City of London usually whisper about behind closed doors. Today is December 15th, 2025. If you're in London, it's cold. If you're looking at your mortgage payments, it's probably sweating hot. We have a massive week ahead of us, folks. The Bank of England is gearing up for a decision this Thursday that, on paper, looks like a gift. Most economists, the betting markets, and probably your neighbor's dog are expecting a 25 basis point interest rate cut. That would bring the benchmark rate down to 3.75%. Hooray, you might say. Cheaper money. The easing cycle continues. But hold your horses. Put the champagne back in the fridge. Because today, we are going to analyze why this gift might actually be a parting gift. We are going to talk about the ghost in the machine, the invisible line in the sand that is terrifying policymakers, and why Andrew Bailey, the governor of the Bank of England, is currently the loneliest man in Britain. Today's episode is titled, The Neutral Rate Trap. Let's look at the battlefield. We are almost a year and a half into this so-called easing cycle that started back in August 2024. But this isn't a smooth ride down a slide, it's a stumbling walk down a rocky mountain. The Bank of England's Monetary Policy Committee, the 9 wizards who decide the price of money, is currently locked in a stalemate that makes the British Parliament look like a harmonious choir. Here is the formation. On one side, we have the Hawks. There are 4 of them, led by Chief Economist Hugh Pill and Deputy Governor Claire Lombardelli. These guys are looking at inflation, which was running at a stubborn 3.6% as of October, and they are sweating. To them, cutting rates now is like pouring gasoline on a barbecue that's already flaring up. On the other side, we have the Doves. There are 4 of them too, including Deputy Governors Dave Ramsden and Sarah Breeden. They are looking at the jobs market, which is cracking. People are losing work, vacancies are dropping, and the economy feels sluggish. They want to cut rates to save the economy from freezing to death. So, math wizards, what's 4 versus 4? It's a tie. That leaves one man. The swing vote. The tiebreaker. Governor Andrew Bailey. For months, Bailey has been floating in the middle like a cork in the ocean. But recently, he's been signaling a shift. In November, he raised eyebrows and heart rates when he started quoting the Taylor rule. Bailey's recent rhetoric suggests he thinks we are nearing the end of the road. If he votes for a cut this week, bringing us to 3.75%, he is essentially admitting that we are dangerously close to the neutral rate. Now, friends, we need to talk about this term, the neutral rate. What is it? Imagine you are driving a car. If you press the gas, the car speeds up. If you press the brake, the car slows down. The neutral rate is the perfect cruising speed where you are neither accelerating nor braking. It's the level of interest rate that neither stokes inflation nor smothers the economy. It is the Goldilocks number. Here is the problem, nobody knows what that number is. It's theoretical. You can't look it up on a website. You only know you've passed it when you crash the car. Governor Bailey and his team are terrified. Why? Because if the neutral rate is 3.5% and they cut rates to 3.75% this Thursday, they only have one cut left in the chamber. Just one. After that, if they cut again, they are pouring gas on the inflation fire. Paul Dales, the chief UK economist at Capital Economics, put it perfectly recently. He said, from now on, every interest rate cut almost has a higher bar. I just wonder whether that automatic nature of cuts just fades away. Translation, the easy part is over. Now comes the hard part. The Bank of England is officially trying to play it cool. They endorse a range for the neutral rate of 2% to 4%. 2 to 4%. That is a massive range. That's like a weatherman telling you, tomorrow the temperature will be somewhere between freezing and boiling. It's technically true, but useless for planning your outfit. Claire Lombardelli, the deputy governor, admitted last week that this range is quite broad. No kidding, Claire. Andrew Goodwin over at Oxford Economics calls this strategy making the concept fuzzy. If they keep it vague, they have maximum flexibility. If they don't tell you where the finish line is, you can't get mad at them for stopping early. But the market isn't stupid. Traders are doing the math. Investors are currently betting that borrowing costs will settle around 3.4%. Economists surveyed by Bloomberg are a bit more optimistic, thinking we might get to 3.25% by the second half of 2026. But let's look at the outliers. There is one guy on the MPC who has given a clear answer, Alan Taylor. He's the new guy, the academic. He puts the neutral rate at 2.75% to 3%. He's the most dovish member. He argues that trade wars and a slowing economy are going to crush inflation naturally, so the bank needs to cut deep and cut fast. But he is outnumbered. The Hawks believe the neutral rate is much higher now than it was before the pandemic. And they have a point. This is where we need to zoom out. This isn't just a British problem. This is a global structural shift. For the last 20 years, we lived in a world of low for long. Low inflation, low rates. Why? 1. Globalization, cheap goods from China. 2. Demographics, lots of workers. 3. Peace, relative geopolitical stability. That world is dead. Gone. Kaput. We are now facing what I call the four horsemen of higher rates. 1. AI investment, companies are spending trillions on chips and data centers. That demand for capital drives up the cost of money. 2. The green transition, fighting climate change requires massive infrastructure spending. That's inflationary in the short term. 3. Defense spending, look at the news. The world is arming itself. Tanks and missiles cost money. 4. Fiscal looseness, governments, including the UK's Labour government, are spending money they don't have. Traders are betting that central banks from Australia to the US will have to pause their easing cycles soon because of these pressures. The price of money has structurally gone up. So, when demographic pressures and lower productivity collide with AI and defense spending, who wins? Right now, the inflation pressures are winning. Let's bring this back to your wallet. The Labour government, led by Chancellor Rachel Reeves, is in a bind. They promised to tackle the cost of living. In last month's budget, Reeves announced measures to try to bring down inflation, essentially trying to beg the BOE to cut rates. But here is the irony: if the government spends more to help people, it creates demand. Demand creates inflation. Inflation makes the BOE keep rates high. It's a dog chasing its own tail. Mortgage rates are determined by where the market thinks rates will end up, not just where they are today. If the market believes the BOE has to stop cutting at 3.5% because of this neutral rate fear, then fixed-rate mortgages aren't going to drop much further. The days of 1.5% mortgages are not coming back, folks. We are settling into a world of 3.5% to 4.5% as the new normal. So, what happens this week? Governor Bailey is watching the data like a hawk. He has placed massive emphasis on the data between November and December. The first round showed price pressures easing. Good. The second round arrives this Wednesday, just 24 hours before the decision. The BOE expects inflation to have cooled by 0.2 percentage points to 3.4% in November. But, and this is a big but, Andrew Goodwin warns of an upside surprise. If that number comes in hot, say, 3.5% or 3.6%, it could derail everything at the last minute. It could hand the hawks the ammunition they need to pause the cuts. Let's summarize the truth behind the event. 1. The cut is coming. We will likely see a cut to 3.75% this Thursday. The Doves plus Bailey have the votes. 2. The guidance will be boring, as Bloomberg Economics predicts. Don't expect fireworks in the press release. They will stick to the word gradual. They dropped the word careful in November, but they won't promise anything. They are buying time until April. 3. The end is near. The easing cycle is running out of runway. Whether the neutral rate is 3% or 3.5%, we are almost there. My take? The Bank of England is trapped. They know the economy is weakening. But they are paralyzed by the fear of inflation resurgence. They are trying to land a jumbo jet on a runway that they can't see clearly because of the fog of neutral rate uncertainty. What does this mean for you? If you are an investor, do not bet on aggressive cuts in 2026. The market is too optimistic about 3.25%. The structural forces of the global economy are putting a floor under interest rates. If you are a borrower, this might be as good as it gets for a while. The cheap money era is in the history books. We are now in the era of expensive but stable money, assuming Bailey doesn't accidentally hit the gas pedal instead of the brake. Final thought: economics is often called the dismal science. But right now, it's more like high-stakes poker. Bailey is holding a pair of threes, the hawks are bluffing, and the doves are trying to order drinks. And the rest of us? We're just the chips on the table. Keep your eyes on the Wednesday inflation data. That is the card that turns the river. I'm the boss. This is Boss Economic World. Stay sharp, stay solvent, and I'll see you on the other side of the rate decision.